You know me, Mario. I'm not the one to try and hype markets. I'm actually always the voice of kind of probity compared to the people who think we're going to the moon. But this, to me, is starting to look like a rocket. We're going up, and you better start buying with both hands.
Monday, January 5th, 2026, Monaco 64, home of alternative economics and contrarian views. Well, today I've got Peter Carlin back on. He's the co-author of A Pocketbook of Gold with Jim Sinclair, who unfortunately passed away a few years ago. Um, and if you're looking for this book, there's a new PDF version. I'm going to put a link to it below in the description. It's a bargain. It's $25. This one here is a collector's item now, and you probably have to search for it and pay hundreds of dollars. So, yeah, check out A Pocketbook of Gold. Peter, welcome back to the channel.
Good to see you, Mario. Lots to
Good.
talk about today.
Yeah. Yeah, a lot happening. Good to see you as well. Happy New Year. And you sent me a message late last week before uh, all the events of this weekend, but it's got nothing to do with what's happening geopolitically. But you told me you wanted to talk about like the futures and the cash market in both gold and silver, that you think it's more nuanced, that there isn't really a huge short out there in the futures, and that a lot of the bullion banks they're playing this spread game or basis game. But you admit as well that they do hypothecate, and it could be a problem if people ask for delivery. And you also told me towards the end of the message that you think Jim Sinclair might have been right, that this time we may never have to sell. And you also say that the forces behind the precious metals are the strongest reasons why. So yeah, let's get your view on these topics then.
Right. The first thing that I'd like to say is that, there's the very thin picture of the mechanics of the market and how the exchanges run. And then there's the bigger picture, which, I think is starting to be impacted by geopolitics. And we're talking about silver here. But remember, silver is a tiny little market, and geopolitics is a very large and important market because it deals in things like global confrontation and kinetic warfare, which really silver plays a very minor role in. The one thing I wanted to say was that there's a couple dynamics at work. Now, the basic banking dynamic is as many of the real experts in the trading world will tell you, the banks are always after the riskless trade. It's great to run risk, but that's how, Bear Stearns got wiped out. They have a situation where people start doing MBS, and then the next thing you know, everybody's screaming, why aren't you doing this? Why aren't you doing this? And incidentally, my co-author of the book, A Pocketbook of Gold, Jim Sinclair, met with Jimmy Kahn about 2 years before Bear blew up. And he had dinner with him because he used to be a partner with him decades before in a business. And he said, if you don't get out of the derivatives position, these guys are going to run, it's going to run you over, and you're going to be out of business in 2 years. So he got it almost to the date. And he said, I can't understand why you're doing it. And Jimmy Kahn, who was CEO of Bear, the inveterate bridge player, said, what can I do? It's 50% of my profits. So, you have this short-term thinking in some places. In the bigger houses, it's more the spread. It's the cash futures spread. You're long physical and you're taking in physical. Of course, that can be encumbered, and you're selling out futures to match the trade with about 3% probably built in, maybe 4 in good days. And who doesn't want to make 4% on a day's trade? I mean, annualize that. That doesn't take a genius to figure out what you're making. And even as Jim said too, because he was probably the biggest cash trader during the 1970s, you take that spread, and then in times of crisis like you're seeing now, what happens is the bullion banks start to evaporate the offer side up, and then they bring it back, and then they evaporate it up. And if you look at COT now, right? If you look at COT now, you're starting to see that massive short futures turn around, liquidate, and start to get COT long. Now that's part covering, and I don't want to dismiss the fact that there could be one or two big players out there who are naked short. Otherwise, how would we get ridiculous things like the MBS debacle? People do crazy things. And also, it should be remembered from the 1970s as well, most of the COMEX Board of Governors was kind of net short too on the ride up, because everybody believes in a reversion to the mean. But we're in a different world now. I mean, you can't just there's no Paul Volcker out there saying, I'm going to put rates up to 10, 15, 18%, to stop this thing. You can't do that anymore with the US debt position. You're trapped down here with the Trump administration desperately trying to keep rates down, 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 and to devalue the dollar. So we live in a different dynamic. But the last thing I wanted to say is that the big spike in the rise in margins, a lot of people see it as bailing out some of the white shoe boys. And I don't deny that could definitely be the case, that somebody was out there leveraged short and the exchange stepped in and said, okay, we're going to do something to help these people. That's been done before. And quite honestly, a lot of people think that was behind Volcker's move with Bunker Hunt. You had the entire COMEX Board of Governors more or less short to Jim Sinclair. And then they said, okay, we have to stop this. Now, whether that's right or wrong is a completely different story. But what you'll see also with the exchanges, that move up on Friday that we had, the Friday before, where we popped like 10% in a day, we had volatility at about 85%. Now, when the exchange looked through and sees the cash position of the length and realizes how small some of the players are and how leveraged they are, God knows what they're doing, 10, 20, 30 to 1, you're going to have to raise margins because you're threatening the exchange now. And if the exchange is under threat, like all entities in the world, it will defend itself. So raising the margin was something that could have definitely been expected. But as you can see, and straight out of the gate this morning, it's not denting the trend at all. The trend is still going. And, that's because what we're dealing with here isn't just a trade problem. It's really, even before the Venezuela situation, but the Venezuela situation is very indicative of the change in the world that's going on. Even before that, you could see that the market was getting tight, and that we're really truly entering a new world, a whole new universe in this world of physical metals that really just pales the 1970s by comparison. And I think most people realize that, who are paying attention, realize that this is a fundamental shift in the market and is going to encounter some really stringent problems along the way. I think less so in America, but in Europe, most definitely. For instance, the European market is still open, but let's not forget, back in the 20s and then again in the 50s and the 40s, markets were shut. And that included precious metals. And it's nice to be on the right side of the market, but, things can be restricted. We don't all live in Texas, Florida, Utah, where, the governments have fought back. A lot of people in the governments now, especially in Europe, would be more than happy to just say, you know what, we're going to shut down the entire market. You're not allowed to hold this stuff anymore. You try and get it out of the country and, we'll prosecute you. So people should be careful about that as well. I don't know if that's coming around the corner. I don't know. Silver's a small market. But I do believe that it's part of our move to platinum. That part of the reason you're starting to see platinum finally catch up is that a lot of people believe that, well, maybe this one has less of a percentage chance of being restricted. So maybe that's where we need to move our next precious metals interest. and it could be the case. What I would like to say though is that I know J.P. Morgan. I don't want to defend them in any way. Gathers the ire of a lot of people, and they show that the spoofing thing that they got prosecuted for and found guilty on years ago and paid several $1 million in fines. That they spoofing is a short-term manipulation for like a matter of minutes or hours. You know how the spoof game works, but it's not necessarily like we're driving the market this way and driving it this way over decades, over years, months. It's a different game. And the other point of it is too is that the thesis of people saying that J.P. Morgan is this huge naked short, and I don't doubt that there are times they have leaned on the market, although I can't prove anything. If they're this massive naked short, well, they're not doing a very good job of it, are they? Because the market's run away with them. So we'll see. I think J.P. Morgan's silver book is very tiny compared to J.P. Morgan's operations.
Yeah.
And, as Bob Moriarty says, the silver market is what J.P. Morgan uses to tip the shoe shine. Boy, it's not a core market of theirs. This is still a thin market, which is why it reacts so violently. But the fundamentals of the market, are real. Although I'd like to say to remember what Jim always used to say too is remember manipulation in the market is always to the upside, and it's usually short-term in nature. Very few people manipulate on the downside. It's not really what's done. What you're seeing now could be manipulation as that two-way market, the offer side gets taken away, gets lifted. And where do we see that more than in retail? I mean, I don't know if you've checked in with the London, retail crowd. It's ridiculous. You've got premiums.
Yeah, the premiums are really high. Yeah, and some dealers don't even have any metal, or maybe don't want to sell it. I don't know. But one thing though that we were talking about before we came on, yes, I agree. The banks, they do the spread or the basis, but wouldn't you agree though that a lot of like counterparties or institutions now, especially like what I'm hearing is like central banks from the Middle East, they're actually coming on COMEX and demanding delivery like regularly, which is something we know that the COMEX is not really a physical market. There's very little delivery. I remember when I worked as a futures and options broker, we had a high net worth client once who was trading a lot of silver, and I told him if you wanna, this was like 2005 or four. I said to him, if you really want to drive the market higher, I would take delivery of huge, physical. That would put the cat amongst the pigeons. And I asked my boss about taking delivery, and he said, forget about it. So, I think that's also impacting the market. And it's more of a fundamental reason, which I think you want to talk about. Is it to do, it seems to be with India from what all the stuff you sent me. Maybe, do you want to get onto that now?
Yeah. And I think what you say is correct too, that the delivery situation, which is the ultimate test of a market, was never brought into question before. And you can see now the geopolitics of the world going on and the moves towards electrification. And as I told you in a previous discussion of ours, I had only started to examine this about a month or two ago to really look at this from a macro point of view. It's a lot more serious than I envisioned. And I think that's why, the people who are talking about India, they have a point. They really do. I mean, if we start off with, well, first of all, okay, we'll leave behind the basis trade because we all know where cash futures is trading. It's about $2 over or something right now. So backwardation is still there.
I've got that chart. Hold on.
Yeah.
The backwardation. Yeah, backwardation is a sign that there's a heavy physical demand.
The
Uh,
demand is still there.
yeah,
There
so
go up on
there
the
you
first
go.
line, second line,
Yeah.
cash against it.
72, 70, 70, 50. Yeah. Two.
That's where we went out on Friday on the
Yeah.
close.
Yeah. Yeah.
So we have that, but you know, when we look at the situation with India, we're talking about a whole new player in the world. We're talking about 1.4 billion people, maybe even 1.5. And if you throw up the GDP chart, I
Yeah.
mean, if an eye open
I've got
in
it here. Actually, I subscribe to trading economics, so I got a longer term chart.
okay.
There you go.
I mean, take a look at the right-hand scale of the market.
Yeah, 9% GDP. Kind of.
Come on. And this is we're tilting at sevens and eights for a decade now. This is phenomenal amount of growth in a country that loves precious metals and is absolutely, exploding in wealth and has a currency that's non-convertible, which you can't really do anything with outside of the country. So of course, you're going to see a demand for precious metals within there. And although most of the demand for metal used to be within the 12 and 18 karat jewelry world of India, silver is now a more manageable purchase. You've got 1.4 billion people with a fair amount of new affluence coming into the market, and the growth is extreme. So they're not going to the Indian central bank's not going to allow a convertible currency. So precious metals it is, and if you look at it also, remember the rupee has been consistently falling against the dollar for a
Yeah.
decade now. And I think we just hit 9 or something.
I did usually I do a end of the year scorecard for the major currencies versus gold. And the rupee is the worst performer. I mean, the dollar was down 64.72%, i.e. gold was up that much, but the rupee, gold was up 73% in rupees. So it's even worse than the dollar.
Right. And also, people in India do not hold US dollars. They don't. Currency is highly restricted. And what they do is try and fly back and forth to Dubai and get some exposure to either the dirham or try and take some silver or gold offshore. So that's part of the thing. Saving in rupees is kind of a mug's game, and you've got this newly affluent society coming from the ground up that needs to be allowed to store some of their wealth, and they're going to use metals as they have done for thousands of years. But now it's a bit more real. It's because the amount of money, because of the GDP growth, is getting far more serious. And it only costs $75 to fly, from Delhi to Dubai. So you may as well use a mule or somebody to try and get the bars offshore. So the demand is there. Also, the Indians, are very big with ETFs, and although it may seem like they don't have a regulated exchange structure that's as responsible as those in the West, I would actually question that. The regulators on Indian silver ETFs are quite strict, and as anybody who knows India knows, there are more regulatory busybodies in India than anywhere on earth per square mile. Every corner, every street corner, every dirt road has some police officer, little guy standing there saying, "Do you have any dollars with you? Do you have an expensive piece of technology with you?" So the rumor is, and don't know the regulatory system that well in India to say, but that they are regularly shutting down small ETFs saying, "We're coming to inspect your physical. You don't have it. We're
Yeah.
closing. That's it." So in that sense, you're seeing real demand start to come in. But if you go to the energy chart, I don't know what
Oil
it's
consumption by country.
Here's the conundrum that you have with
Let
it.
me just bring it up. This one?
Let's have a look. That's the one. So if you look at this chart, right, you can see very clearly from it that, affluence can be measured, by what do we got there? Yeah, by gallons of consumption. So India is a growing economy, but it's still got a lot of poverty. If you look at places like the US and China, Saudi Arabia, look at the Saudi number. That explains not only that they're an oil producer, but it explains the wealth of the average person in the country by how much gasoline they burn, which is a pretty good indicator of wealth in human society. So you can see how small it is with India. So they have this wealth problem. It's got lots of sun, but it doesn't have the money or the ability to burn tons and tons of hydrocarbons. And so, one of the things that's going on in the world now is you could have problems with India getting a hold. Yes, okay. And this also, you'll see, that's their exposure. You can see their exposure to crude oil. It's absolutely massive, absolutely massive. Everything's got to be imported. So if you get into a situation where all of a sudden a lot of your deliveries are in war zones or being shut down, if there's conflict on the high seas, India is in a real problem. It doesn't have any oil system at all within its own. It has refining, but it has no ability to take crude in. And if Iran is next on the table after Venezuela, India, and then, trying to restrict Russian crude on the high seas, India could find itself in a real problem. So word on the street is, and you can see why, that there's going to be a massive dash to photovoltaic.
Yeah, and that's why they're buying silver hand over fist to also to like build solar panels. Like you said, they've got a lot of sun.
No shortage of sun,
Yeah,
but a shortage of crude oil. And
yeah. I
so
mean,
that,
and here's they still don't produce that much electricity compared to their population.
right, exactly. And that has to be brought up to speed to keep the population happy. Also, look at this. I mean, China is off the charts, but look at the slope of the Indian curve.
Yeah,
It might be from a small base, but it's starting to get very, very perky. It's starting to get very vertical.
yeah.
So, so now we can start to see, what's going on with both China and India, who are almost like locked in competition. 1 gigawatt of solar needs 133 tons of silver to produce 1 gigawatt. That's a very steep mountain to climb. And so it seems like we are truly entering the period of physical scramble, but not on a kind of exchange monetary basis even, but on a much more physical, energy related, energy productive capacity basis. And it's mind boggling if this thing takes hold. I don't know what.
Especially, sorry to interrupt you, Peter, especially with the fact that the silver mining production has been lagging behind consumption for the last 5, 6 years.
It's like, yeah, it's like the most inelastic curve in the world.
Yeah, and the fact that
Yeah.
developing new mines takes at least 7, 10, 12 years. This is going to be massive for the silver market, I think.
Right. So you can see between the deliberate attempt to keep the dollar down, shutting down the world economy by trying to cut off South America from China, trying to restrict Russian economic intercourse on the high seas, you're creating this perfect storm. And then with India starting to panic now about where are we going to get crude from? Where are we going to get energy capacity? So you start to see this, and what you're starting to see now.
And also, where are they going to get the silver from as well? Because South America produces a lot of silver, and the U.S. doesn't want bricks.
They want it ring fenced. They want it ring fenced. Yeah, they do. And so, the question for everybody now becomes, and this is the thing that we always used to talk about 10 years ago, as I'm sure you did as well too. To get access to that physical silver is no longer some exchange nonsense. It pales in comparison to what any exchange, LBMA or anything can have. Behind it, COMEX, even Shanghai, Singapore, these are all, will fall by the wayside. People are starting to do off-market deals. They're starting to go in like Samsung just did in Mexico and just buy a mine. That's for us. That silver never hits the market. That's our silver. We're just going to buy mines. Okay, so does that tell you to be in the junior mining game? Probably it does. But what it means is that, you're getting these wholesale deals that are off the market. And, one of the ways you saw this develop was in the ag market and the soft commodities, in what China's been doing with Brazil and what China's been doing with other producers around the world about trying to, get soy and get wheat deals off the ground for 5 years running term, maybe 7 years on a running term, agreed fixed price. That's not going through the COMEX. That's not going through the exchanges. Those are just deals that have been set up, long-term deals that don't even have a price relationship to the exchange. I mean, even the term arrangements that oil importers get from the Saudis, from the UAE, they are price related to Brent. It's a differential against Brent, and the term deal is for volume, and the price adjusts with it so that everybody can work their hedges or do whatever. But these are just flat price deals. People are just coming out, we will give you X per ton for 7 years. Now, this is what's starting to happen, I think, in the silver market. People are trying to go directly to mines, directly to suppliers and say, we'll just off-take the whole thing from you. We'll just take over the mine and we'll pay you out. And there's a rumor in the market, I don't know if it's true or not, that China has just put a $75 silver price under the floor, a floor. Just said, anybody who wants 75 will take all you got.
Yeah, I've heard as well from a contact. I have a friend. He knows a lot of people in the Middle East, like high up. And he said in the last few months, India mostly, but also Saudi Arabia, and I think maybe the Saudis are buying for India. They're buying like 55 million ounces of silver every month. I mean, and you multiply that by 12, that's 80% of world production of silver just by those two countries.
No, it's incredible. And of course, the Saudis have made no secret about the fact that they seriously want to get into the photovoltaic electricity generation game, both for AI application and to distribute energy around the region.
Yeah, they've got a lot of sun there too.
A lot of sun. These are all physical things that us people like me and you from the exchanges, weren't and aren't always exposed to. It's becoming a completely different game now. And, I don't know, when there's a floor under something, it becomes an asymmetric trade. You're either going to stay at 75 or you're going to go up. Yeah. That's not bad. If you want to invest a lot of money in silver, you could say, well, we're pretty close to 75 now. So maybe what I could say is that my worst case scenario is I get my money back. My best case is that silver goes to $150 an ounce. That's not a bad way. That's not a bad trade.
Yeah, it's like the statutory price by the U.S. Treasury for gold. The last time they raised it was in 1973 to 42.22. And after that, I mean, when they raised it, the price was like at 80 or 90, never went back below 42.22.
Never. That's right. That's right. And so, when you set those kind of monetary floors, like they never trade under, they only trade over. And that is the history of the 1960s gold pool failure of Bretton Woods, and the 1970s liftoff. So we could be looking at, a decade or more of this just constantly moving up and constantly moving up.
Yeah.
We see the premiums. Shanghai is like plus 8% or was last week. I'm hearing in India it's 10 to 11% over, which has always been to be fair, has always been the case with India because of restrictions and because of the things that go on with import tariffs that come into India. You're going to get a higher price. But one thing I would say is that India has had tighter restrictions recently to try and protect their jewelry industry, which employs probably, I don't know what, 10% of the population. But those restrictions are going to get lifted in March of
Yeah, I
this.
also saw, Peter, I don't know if you saw this few months ago. There's a national pension system in India, and they've recently said that they can invest, the manager can invest up to 1% in gold and more precious metals ETF. That's something new as well.
Yep, agreed.
Yeah,
And like I said, India, go back to the GDP tables. This trend is only running one way,
yeah,
and
yeah,
that's up and up and up.
yeah,
Because India is the growth story of the world economy right now, albeit from a low base. Still,
yeah,
there's a lot of money in India,
yeah,
and now it's being deployed, and it's being deployed this way. And it seems to me, if you were an Indian politician, you would do the same thing. That you want to encourage your population to have some kind of precious metals exposure, so that when we enter a real monetary shakeup, there's an economic buffer.
yeah, yeah. And to wrap up here, maybe we could touch upon Jim Sinclair and what he said that the next time gold and silver go higher, they might not come back down. Does that, you mentioned that in the note you sent me. Is that apply just to silver, but also to gold, you think?
Oh, definitely to gold, first and foremost to gold. I think what he kind of envisioned was the fact that since the United States was not going to be the sole superpower like it was after World War II, that the next monetary crack up was going to be something that couldn't be easily controlled by simply raising the price of gold, forcing Bretton Woods into the market, even though for a short period of time, and then restricting gold like Nixon did, by taking it off the market and telling everybody, let's create a Eurodollar system. That'll keep everybody quiet for the next 2 decades. It's going to be a lot more chaotic, and there's going to be a move towards more importance of physical metals across the whole spectrum of things, across copper, as you can see with copper moving. And now, quite honestly, for the miners, especially, the offtake metals are going to become really, really big. One day I was up at Jim's in Connecticut, and we were talking, and he said, the mine will make money, the Tanzanian mine, Bulyanhulu and Buck Reef will produce. But I think by the time we get to a real monetary crisis, there'll probably be more money in the nickel I take out of this thing than anything else. And so I think people are starting to move towards other metals. The platinum is starting to move. Nickel looks like the buy of the century. So anything physical that people can get their hands on, there's just the demand there. And I suppose that he foresaw the fact that this time around, when we had a monetary shakeup, since there wasn't one dominant power in the world, you weren't going to be able to control this anymore. It's going to become a free-for-all. And the scramble for silver is becoming a free-for-all. People are just doing anything they can to get it. I will be the first to admit, if I look back at this 3 months ago, I never really thought we were going to get to this position where the whole market was being dislocated and disintermediated around the world. But the exchanges are dying, and the people with the muscle to go in and buy a mine outright, and the people with the ability to simply lift every bit of physical they can get their hands on. It's like watching a scramble for North Sea oil
Yeah, and yeah,
during the Gulf War. People would just lift cargoes, take anything.
And
anything they.
politically, I guess the world's getting divided. It's not just the US dominating everything, even though the US seems to want to focus, I think, on the Western Hemisphere now. And then Putin will get most of Europe, and she will get the rest of the world.
Well, if it could be done peacefully without, having World War III, that might be the best we can hope for.
Yeah.
Yeah.
Anyway,
Anyway, have a
I mean, as we speak here, we've got gold at 4,425, up 93 bucks, the spot price. So it's going again. Silver's up almost $3 or 4% at 75.70. So yeah.
truthfully, from a trading perspective, I think the way that sell off got reclaimed, so quickly. Everybody thought up 10%, that was the flare out to the top, and then the crash, that's it, we're done. The way we've recovered, oh boy, oh boy,
And that's despite the margin hikes.
much, we have got some upside coming. I mean, we quite honestly, I'm not, you know me, Mario. I'm not the one to try and hype markets. I'm actually always the voice of kind of probity compared to the people who think we're going to the moon. But this, to me, is starting to look like a rocket. We're going up, and you better start buying with both hands, because if you don't, somebody else will be. And I hate to say that because I don't ever like to hype a market, but what you've seen in the past 2 weeks, just we're in a new world. We're in a new world now. We're silver's going to $100. There's nothing that can stop it now. And once we get through with consistency, once we get through 4,500, 4,600 on gold, watch out, because we may not even stop that long at 5,000. So here we go.
Well, Peter, it's always great to speak with you, and let's keep an eye on things and maybe talk again soon.
Absolutely.